Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so the AICPA Code of Professional Conduct outlines a set of rules that the auditor must follow in order to be in compliance with the standard. So at the end of the day, the auditor must be both objective and independent. But again, this is the assurance exam, not necessarily the audit exam. So there are more services than just audit engagements that we need to be aware of. Now, keep in mind, we're always going to have to be objective no matter what the service is, but we're not always going to be independent. So what type of services will require independence? That's only going to be for what we call attest services. So what is an attest service? What's the definition of attest? Well, it's a verb and it means to provide or serve as clear evidence of. So how does that tie back to the material? Well, this is going to be when we're providing a much larger degree of assurance, right? This attest service is providing or serving as clear evidence of. All right, so it's going to include audits, examinations, agreed upon procedures, and review engagements. Okay, so don't worry too much about these other engagements just yet. We're going to talk about all of these in much more detail, but just to note at a high level, the independence factor is going to be emphasized during these more robust engagements, ultimately because we're obtaining more evidence and providing the reader of the financial statements with an independent opinion. Okay, so taking a look at this mapped out list by the AICPA, and this list is going to break out all of the rules that the auditor must follow in order to be in compliance with the Code of Professional Conduct. Right, so while you might be sitting there thinking, but Joey, this list is so long, how am I going to remember all the details to this? What I will say is that there is something in each of these rules that we need to be at least familiar with at a high level. Okay, but some of these rules are going to have areas that are more highly tested than others. But the big one is going to be independence. Okay, so the independence rule is a lot more thorough in this exam. All right, so the AICPA loves to test your knowledge on scenarios that would threaten the auditor's independence. So as we mentioned, we have three types of members. We have members in public practice, members in business, and other members. So members in public practice will be subject to all of these rules. Members in business will be subject to less of the rules outlined by the AICPA. And other members will only be subject to the acts of the discreditable rule. Okay, but for now we're zeroing in on the independence rule, right? We mentioned that the auditor should be both objective and independent, but the word independent is more important for the purposes of understanding the audit engagement. Okay, and the whole idea here is that the auditor is coming in as a third party and providing an audit opinion on the financial statements that are presented by management. They're opining on whether or not they are fairly presented and whether they are in accordance with the applicable financial reporting framework. So this rule is arguably going to be the most important element of the Code of Professional Conduct, right? Which again is the framework for the audit professional. This is the framework that Detective Lucy follows. And the idea here is that the auditor must sustain their independence throughout the course of this engagement. And the AICPA has outlined different scenarios and rules that could threaten the covered member's independence. Okay, so we're going to hear that term a lot, covered member. What is this referring to? So this is an individual within an engagement team that is in a position of influence. Okay, so if Detective Lucy is a manager or a senior manager or a partner, they will be considered a covered member. All right, so this could be a partner or manager who provides 10 or more hours of non-attest services to an attest client per year. It could be a partner in the office in which the lead attest engagement partner practices in connection with an attest engagement, and it could be the audit firm. All right, so the AICPA is policing the covered member to ensure that they are not performing this engagement with independence that has been impaired. So we're going to meet Bernice, and she's going to represent the independence police. So anytime you see Bernice, you're thinking, uh-oh, the auditor is no longer independent. All right, so taking a look at our mental map, this is your roadmap for knowing the different rules that might impair independence. Okay, so our big ones are going to be threats from financial relationships, threats from employment relationships, and the threat of business relationships. Okay, so before we just dive into it, we should understand who might be a threat to the impairment of independence. So at the end of the day, this can be due to the nature of the relationship that the covered member has with the client. Okay, but also something very important to keep in mind is that it can also be the nature of the relationship that the covered member's family member has with the client. So which family members are ultimately going to be relevant in this case? So the two terms related to family members that you need to be mindful of consist of immediate family members and close family members. Okay, so think of the immediate family members as sort of this tier 1 category. It's going to include the covered member's spouse, and their dependent children. Okay, so as we said, think of that as tier 1. Think of the close family member category as sort of this tier 2. And you could think of that as this subset of criteria. All right, and it's only going to exist for certain situations. So again, that's going to still include covered members' spouses. It's going to include their dependents. All right, it's also going to include non-dependent children, parents, and siblings. Okay, so who would not be considered a family member? All right, so that's not going to be immediate or close. That could be in-laws, could be aunts and uncles, could be grandparents, could be friends. Okay, so when it comes to the impairment of independence, we have 3 categories that we need to break down at a high level. We can have an impairment due to financial relationships, an impairment due to employment relationships, and an impairment due to business relationships. So starting with financial relationships that might possibly impair independence. All right, so we're bringing out Bernice. She's coming in hot. Okay, she's going to be policing whether or not the covered member's independence would be impaired. All right, so when it comes to financial interests, we can either have an impairment due to direct financial interest or indirect financial interest. Okay, so Bernice is going to be more sensitive to scenarios that include direct financial interest. And the reason is because direct financial interests will impair the covered member's independence regardless of its materiality. Okay, so this is a situation where the covered member could be receiving economic gains directly from the client. Okay, so at a high level, direct financial interest can include a situation where a covered member has ownership in the client's stock, right? This is the covered member saying, I can't audit this client because I own stock in the company. They have a direct ownership. Okay, so another one could be a financial interest in a trust when the member is a trustee. Right here, they're saying, I can't audit this client because the money in my trust is invested in the company. I didn't personally buy this stock, but my trust did. Okay, so maybe the client's an LLP or a limited partnership. If there's a direct financial interest in a partnership, when the member is considered a general partner, this is also going to be impaired. Right? Can't audit the client because I'm a general partner in the partnership. All right, so these are the primary examples that would result in the impairment of independence due to a direct financial interest. Okay, and as we said, this is going to impair the independence of the covered member regardless of the materiality of the direct financial interest. Indirect financial interest, on the other hand, is going to impair the auditor's independence if the circumstances are considered material. Okay, so Bernice is going to be a little bit more relaxed when she's policing this independence here. All right, so some examples of indirect financial interest will include ownership in diversified mutual funds that contain the client's stock. Right, let's say that you have a retirement plan that is diversified. Right, you put all your money in this mutual fund that's invested in an industry. Within that industry contains the client. Okay, so if the client is part of that mutual fund, it would be considered an indirect financial interest, right? Here we're saying I can't audit this client because my defined contribution plan owns stock in the company. All right, the other one would be a direct financial interest in a subsidiary in which the subsidiary has a direct financial interest in the client. All right, so here we're saying I can't audit this client because my firm owns a subsidiary and that subsidiary owns stock in the client. All right, and again, if that indirect financial interest is considered material, then independence would be impaired. Okay, so a couple other scenarios that can impair the covered member's independence due to a financial relationship. Okay, so a big one is going to be the impairment due to lending agreements. All right, and the general rule is that if a member or their spouse has a loan that is to or from the client, then it's going to impair independence. Right, I can't audit this client because either my spouse or I have borrowed money from the client, or I can't audit this client because either my spouse or I have lent money to the client. So with that being said, this could be a loan to or from a client that is not a bank, right? We could lend money with anybody. Okay, but the AICPA extends specific rules for clients that are lending institutions. Okay, so in other words, if the client is a bank. And again, as we said, the general rule is if you're a covered member with respect to an attest client, you or your family member will not be able to have a loan to or from the client. Okay, so that client could be any attest client, it could be an officer or a director of the attest client, or it could be an individual holding 10% or more of the attest client's outstanding equity in securities. Okay, but all rules are meant to be broken. Okay, so we have a few exceptions here. Okay, so again, this is a scenario where Bernice is going to let these exceptions slide. All right, so independence will not be impaired if it has to do with a car loan and this is collateralized by the vehicle. All right, specific to automobile loans. And again, has to be collateralized. Okay, so the next one is if we have credit card and overdraft reserve account balances that are kept current and do not exceed $10,000. We have fully collateralized passbook loans and loans that are fully collateralized by an insurance policy. Okay, so again, this is if the client is a lending institution. And the second exception that we need to be mindful of is the transition provision. Okay, so here we're saying that we have been engaged to audit a client that is a bank, right, or any lending institution. And we're saying that we had an agreement with the bank, but maybe it was before the bank was ever a client. Right, the bottom line is Bernice is trying to prevent the auditor from having any sort of ulterior motives. If Detective Lucy has a relationship with the bank, but can demonstrate that she is transitioning from that relationship in some capacity, then Bernice can let it slide. So a loan may be eligible for a transition provision if the covered member obtained that loan before they became a covered member with respect to the attest client, if this was before the lending institution became an attest client, or if it was before the attest client acquired the loan. Okay, so this one could be a little bit deceiving, so I want to go through a quick example to really drive this home. All right, because this has been seen on the exam in the past. At the beginning of year one, Lucy, a covered member, obtained a loan from one of her clients, the Great Bank of Stetson. At the date of the loan, Lucy was engaged to provide compilation services to the financial institution. All right, so compilation engagements are not attest services, all right, but audit services are. So when it comes to March 2nd of year two, the Great Bank of Stetson asked Lucy to perform an audit engagement on the bank's financial statements for the year ended December 31st, year two. So would Lucy's independence be impaired or not? And the answer is no, because Lucy meets the transition provision. Okay, and the reason is because Lucy had an agreement with the bank before the lending institution became a client. All right, so that's going to meet the criteria, and therefore independence will not be impaired. All right, and the last financial interest scenario that you need to be aware of is the receipt of more than a token gift. What's a token gift? This could be any gift that has a value of greater than $100. Right? I can't audit this client because they gave me a gift worth over $1,000. That's all you got to know. All right, but the big ones you got to keep in mind are going to be direct and indirect financial interests, as well as the scenarios that are included within lending agreements. Okay, so the next scenarios that we're going to discuss that might impair independence is the impairment due to employment relationships. All right, Bernice is coming out again. She's going to analyze and police these situations and say, nuh-uh, you can't audit this client. Your independence is impaired. Okay, so independence can be impaired if the member currently or previously has been employed or is seeking employment by the client and is currently participating in the engagement. Okay, so we're going to focus on the covered member and their family members. Okay, so we remember the difference between immediate family and close family. All right, so the first scenario is going to be a partner professional. So independence will be impaired if a partner employee departs from the firm and is subsequently employed by the client in a key position unless the individual is no longer in a position to influence or participate in the firm's business decisions and the amount due to the individual is not material to the firm. Okay, so again, the covered member could be the audit firm. So if a former managing director of the firm, right, let's say Jim, has left the firm to go be the CFO of the client, well then the covered member, right, the audit firm, is no longer going to have independence. All right, how about a former employee? Okay, so independence will be impaired if the individual has been formerly employed by the client and has participated in the engagement team or is in a position that can influence the engagement when it covers any period of their previous employment with the client. Okay, so if the covered member here is Detective Lucy, and she's saying, we're auditing year two, but I work for the client in year two, right? I'm a new employee of this audit firm, And now that the engagement we're auditing is from the year that I worked for the company, then it's going to impair independence. Okay, so it can't be any period of their previous employment with the client. Okay, so if the covered member themselves was a former employee, then Bernice is going to be a little bit more strict. If the covered member's immediate family member or close relative was employed by the client, then independence can still be impaired, but only if that employment was for a key position, right? If they're saying my spouse is the director of operations at my client's firm. Okay, so that was past employment. What about situations where there's potential future employment? So if the covered member is seeking or discussing potential employment with the client or has been offered a job with the client, then independence again can be impaired. Okay, an exception can exist though if the covered member is removed from the client engagement. Okay, so we're saying we can't audit this client because Rachel, who's a managing director, is now interviewing for the CFO job of the company. All right, unless we remove her from the engagement. Okay, so the next relationship that can impair independence is impairment due to business relationships. Okay, so this is essentially when the covered member is operating and acting in a management capacity on behalf of the client. So what's key to keep in mind here is this could basically be anything that seems like a management decision or provides authorization. All right, so the AICPA outlines these categories as those who are employees, directors, officers, or in any management capacity. It can be a promoter, an underwriter, or voting trustee. It could be a stock transfer or escrow agent. It could be general counsel, or it could be trustees for an attest client, pension, or profit-sharing trust. Okay, so under certain situations, these are some of the different types of business activities that can impair independence. Okay, so bookkeeping and other services related to the client's accounting records or financial statements can impair independence if this appears to be a management decision. Okay, but if they are simply recording data, right, maybe they're taking a trial balance and just making adjusting journal entries, maybe management gave them certain transactions and simply asked them to classify those transactions in the financial statements, or took other provided information by management, like a trial balance, and prepared financial statements on the client's behalf. None of that would impair independence, and the key reason is because the covered member would not be making management-related decisions. They're not authorizing financial transactions. Okay, so that's what's key. Okay, so the next one can include financial information, systems design, and implementation. All right, and the next two I want to focus your attention a little bit more on. Appraisal, valuation, or actuarial services. These are business activities that can impair independence, but only if they are considered material. All right, so Bernice is coming in hot and she's saying, hey, you cannot provide this valuation or appraisal or actuarial service to the attest client if the results of the service would be material to the attest client's financial statements. All right. Alternatively, if it has a significant amount of subjectivity involved, in which case Lucy's independence would be impaired. All right. And that's a bummer for Lucy because that's what she gets paid to do. That's how she earns a living. All right. So some additional business related activities that can impair independence can include internal audit outsourcing services, management functions, right? So anything that might seem like a management decision, human resources, if this is a authorization or management related decision, broker-dealer, investment advisor, or investment banking services, that can impair independence, right? That's a financial-related decision. Same goes for legal services, right? If they are authorizing or providing management-type decisions that are going to provide an economic benefit to the client, then that's going to impair independence. Okay, so some of the other miscellaneous rules that can impair independence. One of the ones they love to test is a situation where the covered member is owed money by the client for a previous attest service performed, right? In other words, this is invoices that are outstanding, right? We're owed money still. Believe it or not, that will impair independence for the covered member, all right? And the reason is because the AICPA sees it like this. If the attest client has outstanding debt with the firm, they might ask themselves, if the client is not paying the auditor, are they really just providing working capital to the client? If the client is not paying the auditor, are they trying to do the client a favor? Is this because they have a financial interest? Right? What's the reason for the auditor not pressing the client to pay them? Why are they doing this audit report in the second year when they weren't paid in the first year? Right? If Lucy performed an audit in year one, still hasn't been paid for year one's audit report, and subsequently performed the year two audit, that's a problem for year two. Independence would be impaired because the attest client has an outstanding debt with the audit firm. Okay, so another one they've been known to test is threatened litigation. Okay, so regardless of who's suing who, right? If the covered member is suing the client or the client is in the process of suing the covered member, independence would also be impaired. All right, but again, something to keep in mind is independence would only be impaired if this lawsuit was considered material.